We process information through a biological mechanism called the encoding gate. When we deliberately focus on relevant information, this gate opens, allowing the hippocampus and prefrontal cortex to assess risk and make decisions. But when we are bombarded by a rapid, overwhelming stream of digital signals, that system struggles to keep up. Staring at dozens of uncorrelated charts and flashing alerts forces the brain into a state of divided encoding. The gate effectively stays closed. You fail to record critical market details, leading directly to decision paralysis and measurable physiological screen fatigue. This exhaustion has a real economic cost. The time you spend monitoring an asset that isn't ready to move actively depletes your finite cognitive capital. While you exhaust your focus on a stagnant chart, you miss the actual high-probability setups happening elsewhere. To fix this, you need to implement a systematic pre-chart scanning workflow. Instead of searching for trades manually, you use your platform's algorithms to weed out the noise before you ever look at a single candlestick. By shifting from a reactive chart-staring approach to a proactive automated screening protocol, you stop wasting energy. You reserve your mental capital exclusively for high-probability market environments. Step 1 is establishing baseline macro filters inside your trading platform screener tool. You want to set specific conditions that prove an asset is active. For example, require the trading volume to exceed its 20-day average and ensure the price is tracking above a major moving average, like the 50-period EMA. This initial diagnostic test acts as a strict filter. It instantly cuts a universe of 5,000 potential symbols down to a few hundred by dropping low volatility, low interest assets. Step 2 is applying a second layer to the scan called multi-timeframe alignment, a concept based on the fractal market hypothesis. This graphic illustrates a top-down constraint. We require structural agreement between a higher macroeconomic timeframe, like the daily chart on the left, and a lower execution timeframe, like the 4-hour chart on the right. You have to avoid the bottom-up trap. That happens when you find a lower timeframe entry signal first, and then manipulate your higher timeframe analysis just to justify your impulse. Always start macro and work down. You also need logical spacing between those timeframes. Using charts that are too close together, like a 5-minute and a 15-minute chart, creates overlapping noise rather than giving you true fractal confirmation. Enforcing this top-down alignment ensures you only allocate attention to assets where both long-term investors and short-term speculators agree on the directional bias. With your list narrowed, the next scanning parameter targets continuation pressure. This is the structural footprint left behind when massive institutional capital is actively flowing in a single direction. To find it, you configure the scanner to look for a specific technical marker within your filtered list, the volatility contraction pattern. This animated diagram shows an idealized volatility contraction pattern. Notice the price consolidating in progressively smaller pullbacks. This tightening indicates institutional demand absorbing sell-side inventory. To confirm the pattern, we observe a distinct volume dry-up during tightest phases, proving supply exhaustion. You can also scan for an alternative continuation signal, momentum bursts. These are visualized by Marubozu candlesticks, candles with large bodies and no wicks, showing that one side of the market is in absolute control. Successfully applying these strict continuation pressure filters should shrink your watchlist from hundreds down to fewer than 10 structurally flawless instruments. By making continuation pressure a mandatory, pre-scanned prerequisite, you eliminate the need to guess or predict market breakouts. You safely position yourself to participate in established momentum. The final step organizes your surviving symbols into a strict decision hierarchy. Thousands of data points enter the top, pass through your momentum and fractal alignment layers, and output exactly 3 prioritized assets at the bottom. Now you manually rank these final few tickers. You evaluate them based on their specific asymmetric risk-reward ratios and their immediate liquidity conditions. The operational rules of this hierarchy are rigid. Allocate your attention strictly in order. If set up one trigger, execute it. If none trigger, do nothing. Eventually, you will run into a zero-result scan, where no assets survive your filters to make it to the hierarchy. In volatile or choppy conditions, inactivity is a deliberate protective strategy. It prevents revenge trading and keeps you from taking impulsive, low-quality positions. Executing a strict decision hierarchy turns opportunity cost into a weapon. By knowing mathematically exactly what is best to trade, you can confidently ignore the noise of everything else. Your daily process is now entirely different. You no longer open the platform wondering what to look at. You press a button, the scanner applies the rules, and it presents you with a qualified hierarchy. This eliminates emotional bias and drastically reduces decision fatigue. Most importantly, it keeps your brain's encoding gate open for when you actually need it. You are using algorithms for what they do best, the heavy lifting of processing massive amounts of data. This frees up your human edge, interpreting the broader context and exercising final execution judgment. Your attention is your most finite and valuable asset. Configure your platform's filters today. Let the machine search so you can decide.